Preparing for a FP&A Analyst at Unilever interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a business like Unilever? FP&A connects financial information with commercial decisions. At Unilever, I would help translate brand plans, pricing, promotions, volumes, and cost assumptions into budgets and forecasts. I would then compare actual performance with expectations, explain the drivers, and work with marketing, sales, supply chain, and finance colleagues on corrective actions. The role is not simply reporting numbers, it is helping leaders make better choices while protecting profitable growth and maintaining disciplined financial control. While answering, focus on planning, forecasting, performance analysis, decision support, cross-functional partnership, and translating financial results into actions across brands, categories, channels, and markets. Question 2. Why do you want to work in FP&A at Unilever? I am attracted to Unilever because its portfolio creates a direct link between financial analysis and everyday consumer behavior. An FP&A analyst can assess how pricing, promotions, innovation, distribution, and input costs affect performance across markets. I also value the company's international scale and the opportunity to partner with non-finance teams. This role would let me build rigorous forecasting and reporting skills while contributing to decisions that influence brands, customers, and long-term profitable growth. Make sure to cover Unilever's global consumer goods scale, portfolio of brands, data-rich commercial environment, interest in business partnering, and how the role supports both analytical development and practical decision-making. Question 3. How would you build a monthly sales forecast for a Unilever category? I would begin with a baseline using historical sales, seasonality, recent run rates, and customer or channel trends. Then I would layer in known price changes, promotions, distribution shifts, innovation launches, supply constraints, and competitor activity. I would separate volume, price, and mix effects so the forecast is commercially understandable. Finally, I would review assumptions with sales and marketing, quantify upside and downside risks, compare the forecast with prior versions, and update it through the cycle. In your answer, talk about historical trends, baseline demand, volume, price, mix, promotions, distribution, innovation, seasonality, market intelligence, stakeholder input, and documenting assumptions with clear risks. Question 4. What is the difference between a budget, forecast, and actual result? Budget is the approved financial plan and performance benchmark for a period. A forecast is management's latest estimate of what will happen, incorporating new information and usually updated more frequently. Actuals are the results recorded in the financial systems. I would compare actuals with both budget and latest forecast, explain the operational drivers, and determine whether a variance is temporary, timing-related, or likely to affect the full-year outlook. Be sure to mention that budgets establish targets, forecasts provide updated expectations, actuals record realized performance, and variance analysis explains differences for accountability and forward-looking action. Question 5. How would you explain a revenue variance to senior management? I would start with the size and direction of the variance, then bridge it into volume, price, mix, foreign exchange, timing, and portfolio effects. For example, revenue may be below plan because volume declined in a major market, partly offset by pricing. I would validate the explanation with commercial teams, distinguish controllable from external factors, and state the expected full-year impact. I would finish with actions such as reallocating promotion or revising the forecast. Focus on quantifying the variance, separating volume, price, mix, foreign exchange, timing, and scope effects, identifying root causes, linking them to actions, and communicating succinctly without hiding unfavorable results. Question 6. What is volume, price, and mix analysis, and why is it useful? Volume, price, and mix analysis explains why sales changed beyond the headline percentage. Volume measures units sold, price captures changes in average selling prices, and mix reflects the different products, pack sizes, channels, or markets sold. A category can grow revenue through pricing while losing units, which may signal demand pressure. I would use the bridge to evaluate commercial quality, assess margin consequences, and determine whether growth is sustainable rather than purely nominal. While answering, define each driver, explain how they reconcile sales changes, distinguish favorable and unfavorable impacts, and connect the analysis to pricing decisions, portfolio strategy, margins, and management actions. Question 7. how would you investigate an unfavorable gross margin variance? I would first reconcile gross margin against plan by separating revenue drivers from cost drivers. On the cost side, I would review commodities, packaging, labor, manufacturing variances, freight, foreign exchange, and standard cost updates. I would also test whether promotions or unfavorable product mix reduced realized margin. After identifying the main causes, I would confirm them with procurement and supply chain, assess whether they are temporary or structural, and reflect the conclusion in the forecast and action plan. Make sure to cover price realization, product mix, commodity and packaging costs, manufacturing efficiency, freight, foreign exchange, promotions, standard costs, timing, and distinguishing one-off from structural issues. Question 8. How would you evaluate the financial impact of a price increase? I would model the price increase using a clear bridge from current revenue and contribution margin. The key assumption is volume elasticity, how many units might be lost as price rises. I would test multiple scenarios, including competitor reaction, customer timing, promotional support, channel mix, and cost inflation. I would compare incremental price benefit with lost volume and any margin impact. Before recommending implementation, I would align assumptions with sales and marketing and monitor post-launch results. In your answer, discuss the starting revenue and margin baseline, expected volume elasticity, competitor response, customer timing, mix, trade investment, contribution margin, and scenario analysis before and after implementation. Question 9. How do promotions affect FP&A analysis in a consumer goods business? Promotions can increase shipment volume without creating equivalent profitable demand. I would compare promoted sales with a realistic baseline, include discounts, customer funding, displays, and other trade investment, then assess net revenue and contribution margin. I would also consider cannibalization between products and whether purchases were pulled forward, creating a post-promotion dip. The right measure is incremental profitable growth, supported by post-event analysis and a consistent learning loop for future plans. Focus on incremental versus baseline volume, promotional spend, customer funding, cannibalization, timing shifts, net revenue, margin, post-promotion dips, and evaluating return on investment rather than only sales uplift. Question 10. How would you analyze marketing and advertising spend at Unilever? I would begin by comparing planned, committed, and actual spend by brand, market, and campaign. I would then connect spending to objectives such as awareness, penetration, trial, or sales, recognizing that brand investment may have a delayed payoff. Where data permits, I would evaluate incremental revenue and contribution margin, not just total sales correlation. I would also review budget phasing and execution with marketing, ensuring cost control does not undermine long-term brand strength. Be sure to mention budget phasing, committed versus discretionary spend, campaign objectives, reach, brand health, incremental sales, contribution margin, lagged effects, and balancing short-term returns with long-term brand equity. Question 11. What would you include in a monthly management report? I would include a concise executive summary, key financial KPIs, actual versus budget and forecast, and bridges for revenue, gross margin, operating expenses, and profit. For Unilever, I would highlight volume, price, mix, brand or category performance, promotional effectiveness, and major cost pressures. Each variance should have an owner, root cause, and action. I would use visuals for trends and exceptions, keeping detail available in supporting schedules rather than overcrowding the main report. Talk about concise KPI trends, actual versus budget and forecast, revenue and margin bridges, risks and opportunities, cash or working capital indicators, operational commentary, and clear recommended actions for decision makers. Question 12. How do you ensure accuracy when working with large financial datasets? I use a controlled process rather than relying on a single spreadsheet check. I validate source files, confirm period and currency definitions, reconcile totals to the general ledger or approved reports, and investigate unusual movements. I build checks for missing data, duplicate records, unexpected sign changes, and variances above thresholds. I also keep documented assumptions and version control, then perform a final reasonableness review before sharing results with stakeholders. While answering, cover source validation, reconciliations, control totals, consistent definitions, automated checks, exception reviews, version control, documentation, and independently reviewing outputs before distribution. Question 13. Describe how you would use Excel in an FP&A role. I would use Excel to build transparent analyses rather than opaque workbooks. Typical tools include SUMIFs, XLOOKUP, pivot tables, logical checks, scenario tables, and charts that explain trends. I would separate inputs, calculations, and outputs, use consistent sign conventions, avoid hardcoding, and include control totals. For repetitive reporting, I would explore Power Query or approved automation. Most importantly, I would design the file so another analyst can understand, update, and challenge it. Make sure to mention structured models, SUMIFs, XLOOKUP or index match, pivots, logical checks, scenario tools, charts, data cleaning, transparent formulas, and avoiding unnecessary complexity or hardcoding. Question 14. How would you approach a forecast when historical data is unreliable? I would first identify why the historical data is unreliable, whether from system changes, missing periods, product launches, or inconsistent definitions. I would triangulate using customer shipments, units, market data, operational drivers, and comparable categories or markets. Instead of presenting false precision, I would create base, upside, and downside scenarios with explicit assumptions. I would validate the model with commercial and supply chain teams, document limitations, and improve the data foundation for subsequent cycles. In your answer, discuss diagnosing data quality, triangulating alternative sources, using operational drivers, applying conservative assumptions, scenario ranges, stakeholder validation, and documenting limitations transparently. Question 15. Tell me about a time you found an error in a financial report. In a previous reporting exercise, I noticed that a month-on-month expense increase did not align with the underlying invoices. I traced the issue to a duplicated data load caused by a file being uploaded twice. I quantified the impact, informed my manager promptly, corrected the report, and checked whether other periods were affected. I then added a duplicate record check and documented the process. That experience reinforced that timely escalation and root cause controls matter as much as correction. Be sure to structure the example with context, detection method, financial impact, immediate correction, communication, root cause analysis, and a control improvement that prevents recurrence. Question 16. How would you manage conflicting deadlines from different stakeholders? I would clarify the purpose, deadline, decision impact, and minimum required output for each request. I would rank work based on business urgency, reporting commitments, and dependencies, then communicate the trade-offs clearly to stakeholders. If two deadlines genuinely conflict, I would ask my manager to confirm priorities rather than make assumptions. I would provide an initial answer where possible, follow with deeper analysis, and keep stakeholders updated if new information changes the timeline. Focus on clarifying business impact, agreeing priorities, confirming required precision, communicating realistic timelines, breaking work into milestones, and escalating conflicts early rather than silently missing commitments. Question 17. What is working capital and how would FP&A monitor it? Working capital is the cash tied up in operating assets and liabilities, especially receivables, inventory, and payables. I would monitor days sales outstanding, inventory days, payable days, aging, stock levels, and forecast accuracy. At Unilever, inventory decisions must balance cash efficiency with product availability and customer service. I would investigate unusual movements with commercial and supply chain teams, quantify the cash impact, and include working capital actions in the forecast and performance review. In your answer, define working capital, explain receivables, inventory, and payables, discuss cash conversion, operational drivers, forecast impacts, and balancing liquidity with service levels and supplier relationships. Question 18. How would foreign exchange affect Unilever's reported performance? Foreign exchange can affect transaction costs, translated revenue, translated expenses, and reported profit when local results are consolidated. I would separate constant currency performance from currency translation to determine whether growth came from operations or exchange rates. I would also consider the currencies of sourcing, production, and sales, plus any relevant hedging effects. Presenting both reported and underlying local currency trends helps management distinguish commercial performance from accounting translation noise. Talk about transaction and translation effects, local currency versus reported growth, constant currency analysis, hedging where relevant, geographic exposure, and avoiding conclusions based solely on sterling or euro reporting. Question 19. How would you assess a new product launch from an FP&A perspective? I would build a launch case covering market size, expected distribution, price, volume ramp, promotional support, advertising, manufacturing cost, logistics, and working capital. I would separately model incremental sales and cannibalization of existing products. The analysis should show revenue, contribution margin, cash needs, break-even timing, and downside risks if distribution or repeat purchase underperforms. After launch, I would compare actual indicators with assumptions and recommend changes to pricing, investment, supply, or the forecast. Make sure to cover market size, distribution, pricing, volume ramp, cannibalization, launch investment, production costs, working capital, scenario analysis, break-even timing, and post-launch performance tracking. Question 20. How would you be an effective business partner to sales or marketing? Effective business partnering starts with understanding the commercial objective before discussing the numbers. I would learn the team's drivers, provide analysis in practical language, and challenge assumptions respectfully when evidence suggests a risk. For example, I might show that a promotion increases volume but reduces contribution after trade investment. I would focus on alternatives, not simply reject the plan, and agree measurable follow-up actions. Credibility comes from accuracy, responsiveness, and consistently linking finance to business outcomes. While answering, emphasize curiosity, commercial understanding, constructive challenge, simple communication, shared ownership, actionable insights, data credibility, and building trust without compromising financial discipline. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.